Talk about mergers and acquisitions, deals in Sub-Saharan Africa. Despite infrastructure challenges, political instability, macroeconomic headwinds, investment flows and transactions have remained resilient, with market factors presenting growth opportunities. KPMG has observed the deals that took place in the region in 2023, put together a report on how investors are strategically approaching the region, and the report looks at sectors and markets that have, piqued investors' interest, strategies employed by those investors to achieve deal success, and risk management policies adopted by investors to overcome challenges for deal making. I really enjoyed this report, and we're happy to have Ijeoma Emezie-Ezigbo, who is a partner, head of transaction services at KPMG West Africa, to discuss. Good morning to you. Thank you so much for joining us.
Good morning, Rotis.
And we always, every time we go through one of these reports, we want to let our audience know the amount of work that went into it. So please, let's start with that. Tell us what it took to put this awesome report together.
Thank you, Rotis, and good morning, and it's a pleasure to be here. And thanks for that question. Really one I would be happy to answer, considering that most times we see the product and not really the effort that goes into it.
Right.
This is our fourth edition of doing the deals report in Africa. The first two focused on Nigeria alone, and then the subsequent two focused on Sub-Saharan Africa, because we realized that our clients and our investors had started wearing an African lens more than a Nigerian lens. So we decided to evolve with them and then focus on Sub-Saharan Africa. The putting the report together is quite a rigorous process. We carefully selected our partner for this purpose. We work with Major Markets. Major Markets is a UK-based M&A intelligence market research firm that we have worked with from the beginning. So we've worked with them over the last four editions. But we have a One Africa Deal Advisory team, a One Africa Deal Advisory thought leadership team, considering that this is an Africa-focused publication. And we have the team drawn from our member firms within those regions, in Southern Africa, in East Africa, in West Africa, and in Francophone Africa. This team works with the major markets first to determine the composition of the survey respondents in terms of the proportion of domestic and international respondents, strategic and financial investors, as well as the sources and destination of the transactions. And then they work with them to develop the questionnaire, review the questionnaire. Major Markets primarily is responsible for deploying the questionnaires and conducting the interviews. But then post that, we then spend a lot of time reviewing the data and analyzing and trying to present the insights from that data and then sharing with the public. For me, it's something that is very, very insightful to read. Just hoping that we can share the experience from these deal makers, the practical experience to help us shape really a landscape in Nigeria and the region.
Fantastic stuff. Again, thank you for making the time to come and talk to us about it, because yes, we do appreciate the work that goes into these things. So let's jump in. Two charts that we picked out showing on a quarterly basis and also on an annual basis deals through the year. I think this one is this is quarterly, and I almost like it speaks for itself. Look at 2020. I mean, so low. You had that big spike in 2021. And then for our viewers, the bar is volume, the line is value in US dollars. So number of deals versus the value of them. And then also on an annual basis, I think going to 2013, up to 2023. So talk to us. Is it COVID had an impact here and then things rebounded a bit?
Sure, yeah, and thank you for that question. This is one chart that I also found very insightful. So yes, COVID happened in 2020. Yeah. Before COVID, we saw a bit of stability in the deals volume and also the value. But in 2020, because of COVID, we saw significant dip, about 30% dip in volume of deals.
Oh, wow.
And down to 10 billion in terms of value, which is very, very low. But in 2021, we saw a significant rebound to 90 billion, which was very high. But just to put it out there, that one deal, a NASPA's deal in South Africa, contributed half of that deal volume. About 46 billion.
We're going to come back to that. Yeah, okay.
But post the 2021, we've seen a bit of moderation in deal value and in deal volume. To about 19 billion, both in 2022 and 2023. So a bit of stability we have seen in terms of value. But another interesting part of the chart is in terms of value terms. So you see that even though the volume is significantly higher than our pre-COVID volumes, we are seeing significant lower value. And that's really because when you look at the currency depreciations, the value of the transactions have shrunk in USD terms. So while we are still seeing significant increase in local currency terms, because of the devaluations across the region, we've had significant currency devaluations over the last 2 years, about 27% in East Africa, 30% in 30% in Ghana, 100% in Nigeria, by the way, and South Africa that has done significantly better, about 7%. So those have driven lower value in terms of USD. But also just to put out there that if you recall our last publication last year, we saw there was this significant response from the respondents on the shrinking size of the transactions. About 60% of the deals done that last year were within the 5 million to 50 million range, which was something that we didn't see before.
Okay, thank you for that. Okay, this next one is, I have to control myself here because I might sit here for the rest of the show on this one, and I really want to talk to you about this. I brought this up on the morning show this morning, and I just thank you for putting this together. The top 10 deals across Africa. I would like for you to speak to the sectors that dominated, because mining was the top sector, followed by oil and gas, and then you've got renewables, technology, and I think leisure. And then you just mentioned NAFSAs a few minutes ago, the dominance of South Africa. For our viewers to look at the targets and just look at the number of flags there. So I think the first one is Botswana, and then you got South Africa, what's that? Zimbabwe, South Africa, Angola, and then you got South Africa again, and then I think Zambia and South Africa. So it's just dominated by South Africa. So yes, what's your take? Maybe I've spoken too much. What's your takeaway from the top 10 deals in Sub-Saharan Africa?
So, consistently over the years, one of the reasons why investors seek to do investment or make investments in Africa is the abundance of physical assets. And these physical assets really are driven by our investments in our natural resources, especially the mineral sector. The continent holds 30% of the global mineral reserves, so quite rich in mineral reserves. And then when you look at the sort of investment that have gone in by multinationals over the years, so you've seen investment by multinationals in this sector who, three things: they have the permanent capital to invest, so they're not like financial investors looking to exit. They have the operational experience to invest and operationalize these assets and optimize their returns. And third, they have long-term view to investing in the region. So they want to optimize the assets, invest, operationalize, create value, and create long-term returns. Now, when you look at the investments that have gone in, the top 10 transactions, like you rightfully mentioned, we had 8 in the sector: mineral, mining, and oil and gas. Oil and gas predominantly being oil and gas, mining and energy including oil and gas and renewables.
Right.
We have 4 investments in mining, 3 investments in oil and gas, and 1 investment in renewables. And 2 of those investments, by the way, in mining, I think mining was the top, grew 140% to 5 billion. 2 of those investments, if you look at, were made strategically by Chinese companies seeking to invest in low-carbon minerals, copper and lithium, and 2 billion. And one of those transactions contributed 2 billion out of the 5 billion. So very significant investments going in South Africa. When you look at also what the South African government has done over the years to attract investment in the mining sector, very, very significant investment they're making in terms of looking at how you invest across the sectors, so supporting sectors, so investments going into energy, investment going into transportation, whether it's to help the mining companies optimize their energy use and also drive ease of evacuation of the minerals from the mines. When you also look at the sort of investments they're making in decarbonization initiatives, trying to integrate renewable energy into the mines to help them cut their costs. We have a data that shows that the companies have been able to optimize their costs by 30% over the last decade.
Oh, wow.
When you see that huge cost optimization, you begin to imagine the sort of value that can be created by these companies, especially when you have strategics coming in to invest and help them still create more value and optimize the operations of the mines. So I think you would continue to see this sort of investments going on in Southern Africa, not just in South Africa, in Botswana, in Zimbabwe, more than you would see in Nigeria.
Well, perfect that you landed on the exact point that precedes my next question, which is why Nigeria has not been able to do all the things that you have just mentioned in South Africa, in Botswana. So I'm sorry, my audience is probably tired of this. I've played this clip about 10 times, but I'm going to play it again for you. This is an analyst we had talking about the mining sector.
We also need to be able to get mining up. Like I said, the analysis of the GDP report by the MBS that just came out today is still hovering around 3%. We should be doing 7 to 10% for mining and quarrying. We can do that once we get the majors in. But how do you get the majors in? The fiscal incentives have to be set right. Security has to be set in stone. So there's a lot of governance from policy to security governance, and we're not seeing a lot of that. Kudos to the Ministry of mining, especially Kayode Fayemi's time, they did a lot of heavy lifting when it came to policy frameworking, and we're seeing the benefits of policy frameworking, because whether we like it or not, the mining sector is at the highest activity rates. Anybody who has spoken with anybody in mining, they'll tell you just that. The problem is the insecurity and the lack of structure. It's affecting the majors from seeing the mining space as attractive.
So I have to have you add to that, because that was when GDP came out, right? And we always look at how poor mining is performing. So what do we need to do here?
So I think I'll just add just a little bit to it. Rosie, this is a very tricky question, so I'll stay away from the politics.
I understand.
When you look at the contribution of the mining sector in South Africa, so this was something that I also asked myself when I saw the report, to say why the huge disparity between the performance of the mining sector in South Africa and in Nigeria. So we try to kind of do a bit of research to understand what's going on. When you look at the contribution of the mining sector to GDP in South Africa, that's about 6% and 25 billion annually. When you look at in Nigeria, that's about just 1% and about 2 billion annually. Wow. So you can see the huge difference. I had mentioned before the sort of investments going into the mining sector in South Africa, right, with respect to decarbonization initiatives, investment in supporting infrastructure, investment with within the right policy framework, and of course the stability of the country. Stability in terms of macro. I mentioned about the exchange rate just depreciating about 7%, inflation is single digit at about 4%, etc., etc. So investment across the region is a macro issue, and is a holistic. It needs to have a holistic framework to be able to pursue some sort of transformation of any particular sector. When you look at Nigeria, for example, the ease of doing business. I know the likes of the PEBEX did significantly a lot in ease of doing business, but when you look at the attractiveness index for South Africa, for example, ranked 15th in the Fraser Institute Investment Attractiveness Index. Nigeria wasn't in the top 50, and we all know the reason. So whether it's what the guy has mentioned, insecurity, etc., etc. But for us, the reason, one of the motivations for us doing this is to be able to present the data and share the insights, and hopefully expect that it can help us shape our policy environment. One of the things that we expect that would happen is for us to look at the mining, not just the mining in isolation, but the whole ecosystem that supports the mining sector, to be able to attract the right level of investment and keep the capital in the region. Thank you so much. Very, very in-depth response there. Very quickly, as I said, I took too much time on mining. Let's see if I quickly race through the rest of this. The way the deals were financed, a lot of cash reserves by these companies as opposed to loans. Is that a testament? I think we have a chart on that. Is that a testament? Yes, there's the chart. So is that a testament to what? High cost of borrowing? Well, what's your quick thoughts on how these deals were financed and why mostly cash as opposed to getting loans from banks? Sure, that's a good perspective to it, and you're very right. When you have a high interest regime, for Nigeria that we're in the 30s, for example, it becomes a disincentive to be able to finance M&A transactions with debt. Because of the huge implication of interest payments, right? And of course, the business are not able to attract investment or attract debt capital from the debt capital markets, right? Whether it's long-term corporate bonds, etc. We are seeing a bit of that dwindling when it comes to financing M&A transactions. Especially more so when you have to think about the additional capital investment that these businesses require post-deal to create the sort of value that the businesses want to create, or to be able to drive their business strategy going forward, right? So it's best, what we're seeing is that most investors prefer to use their cash reserves, and they leave the possibility of raising debt in debt capital markets for future financing of the business to be able to achieve their value creation roadmap. Fantastic. Also, pretty quickly, the business cycle that the target firms were in, the most popular one, according to your report, was growth and maturity. And I was, is it risk that I make them avoid distressed deals and also turnarounds, which are on the lower end to the right of the screen? So, I guess, why maybe it's an obvious question. Why are they chasing growth and mature businesses? It's very obvious, I think. It is obvious. You said it. Yeah. It's very obvious. Yeah. When you think about the sort of returns, the risk-adjusted returns that investors are expecting, and the opportunity cost of the capital that are deploying in these transactions, then you then begin to wrap your head around, why would I invest in a distressed business versus high-growth businesses? Right. In the high-growth businesses, is easier to add significant value from a value creation standpoint, to add significant value to those businesses to drive your returns. And in mature businesses also, you can add significant value to those businesses from a value creation standpoint. But more than anything, it depends on the cash profile of those businesses. If they have rich cash profiles, so the cash cows, for example, you are able to use the cash from those businesses to diversify, to expand the business within the value chain to the extent that that opportunity exists, or diversify into another sector completely to be able to increase the return on investment. So ultimately, it's down to what sort of return would you have.
Right.
When you look at the continent and the challenges of doing business in the continent, it's difficult to see investors who want to go for businesses that are distressed because just the sheer energy and the capital that you require, especially when you look at the high interest rate environment, the sort of investments that you require to be able to turn them around may not be value for money at the end of the day.
Fantastic. This is such a good report. I see they're telling me now we got to hurry up. Okay, real quickly, I really want you to talk on just the risk, and maybe this will end this here. Maybe we'll bring you back. But the risk part, this chart here, and this, I think, does this speak to corporate governance? When the businesses you talked about, that's the question. What are the biggest challenges in completing your most recent deals in SSA? I think one of the highest ones there, they said the valuations, and then second was transparency issues. Can you speak to that?
So when it comes to valuations, we've seen significant divergence between expectations of the sellers and the buyers.
Right.
And this is really also back to the issues that we have with respect to currency devaluations, especially because both parties want to be settled in foreign currency terms.
Right.
So, you know, years ago, 3 years ago, when the currency was a bit stable at exchange rate of 400 naira to $1, sellers had expectation of, let's say, $100 million, right? And then today, the expectation is still $100 million, right, even though the currency has significantly devalued. So that expectation gap makes it very difficult to have negotiations around valuation to be able to close the deal. We are seeing instances where, or what we recommend with our clients to be able to mitigate is to have the right set of advisors walk through.
Like KPMG.
Exactly, like KPMG, of course, to be able to walk through with you on your plans, on your value creation plans, your business plan, et cetera, to be able to arrive at an indicative valuation range or pricing range to help you guide the sellers in the negotiation with the buyers so that, you know, we can sort of bridge the gap. The second area is on transparency, like you mentioned, and transparency is in terms of the financial and non-financial information that is available for the due diligence. Now, we see it in instances where these are not available or the quality of same are not at the right quality. It extends the due diligence process. And once it extends the due diligence process, it then makes it a bit more cumbersome for both transactions to close successfully. Over the years, what we have seen is capacity building. Working with SMEs, working with private businesses especially, is less seen in public entities because those ones, by virtue of the fact that they have to comply with the regulations of the stock exchanges, oftentimes the quality of their financial information is great. But for the private sectors, for the private businesses and SMEs, we've seen a lot of investment go into those sectors by the development finance institutions, enabling them build capacity with respect to preparing the right quality of financial and non-financial information to support investment.
We have to bring you back. Solid stuff. Thank you so much. Ijeoma Emezie-Ezigbo, Partner, Head of Transaction Services, KPMG West Africa. We're actually going to the National Assembly now to watch the President defend the budget or present it. Thank you so much for your time. Fantastic report.